Want to own a slice of one of America's best businesses? Like the idea of getting a market-beating yield that comes with a 20% dividend growth rate? Looking for a good deal on a high-quality Dividend Aristocrat? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Feber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is one of the world's largest home improvement retailers. A quote that sticks in my head comes from a famous bodybuilder named Ronnie Coleman. I'm paraphrasing here, but it goes something like this. Everybody wants to be a bodybuilder, but nobody wants to lift heavy weight. People naturally want all upside and no downside. Well, likewise, a lot of people want to own their own home. It's part of the American dream, right? But none of these people want the constant upkeep, repairs, and modifications that come with owning their own home. No matter, because houses are physical structures that are slowly decaying and require all of this. That's why this company continues to rake in the cash and pay an ever larger dividend. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Lowe's Companies Inc., which appear to be trading at a significant discount today. Lowe's Companies Inc., stock ticker LOW, is a large home improvement retailer based in the United States. Founded in 1921, Lowe's is now a $118 billion by market cap retailing giant that employs 300,000 people. Lowe's operates approximately 1,700 home improvement and hardware stores in the US. The typical store averages around 112,000 square feet in size and offers 40,000 different products. In addition, the company offers hundreds of thousands of products via their special order system and e-commerce channel. You almost can't talk about America without referencing what's known as the American dream. It's a set of ideals based around freedom and prosperity. And part of this prosperity relates to an aspiration toward homeownership. Homeownership is as American as baseball and apple pie. Well, what do we know about houses? They're physical structures that naturally decay over time, requiring constant upkeep and repairs. Moreover, because most people want a house to be a home, one that's customized to their needs, houses almost require ongoing modifications. All of this plays right into the hands of large home improvement retailers. These retailers cater to homeowners' needs by providing the right products and/or services for the job. Plus, as the US population continues to grow, new houses need to come on the market in order to shelter all of these people. That's even more housing stock that will age and decay over time. So it's ever more products and/or services to ever more customers at ever higher prices. And because of that, Lowe's should be able to keep increasing its revenue, profit, and dividend for decades to come. Lowe's has already increased its dividend for 60 consecutive years. That is super impressive, especially in retailing, an area of the economy that is notoriously competitive and difficult. It qualifies Lowe's for its esteemed Dividend Aristocrat status more than twice over. I think this kind of reliability, 6 straight decades of ever higher dividends, is worth something. Making matters even more impressive, the 10-year dividend growth rate is 20%. You might not be totally surprised to see a high dividend growth rate like this from some new upstart fresh into their dividend hiking journey, but for a company that was already 50 years into that journey a decade ago, That's noteworthy. And with a low payout ratio of 30.4% based on fiscal year 2023 earnings per share guidance at the midpoint, even after all of the aggressive dividend growth, this is a well-protected dividend. The only drawback here might be the yield at 2.1%. The stock isn't a big income play. Instead, this is a high-quality compounder for those with the time horizon, patience, and vision to see it through. That said, this yield does beat what the broader market gives you, and it's 40 basis points higher than its own 5-year average. These are phenomenal dividend metrics in my view. Looking at business growth, Lowe's expanded its revenue from $53.4 billion in fiscal year 2013 to $97.1 billion in fiscal year 2022. That's a compound annual growth rate of 6.9%. Strong top-line growth here. I usually look for mid-single-digit top-line growth from a mature business like this. Lowe's obviously exceeded my expectations, although it's been a prime beneficiary of certain pandemic trends, such as moving to the suburbs and or working from home. Earnings per share swelled from $2.14 to $10.17 over this period, which is a compound annual growth rate of 18.9%. Incredible. Excess bottom line growth was driven by a combination of margin expansion and share buybacks. For perspective on the latter point, the outstanding share count has been reduced by a stunning 41% over the last decade. That's one of the largest repurchase programs I've come across. We can now see how Lowe's was able to afford the 20% dividend growth rate over the last 10 years. Like earnings per share growth, funded most of it, allowing the payout ratio to avoid being expanded too much. Looking forward, CFRA believes that Lowe's will compound its earnings per share at an annual rate of 7% over the next 3 years. This would obviously be quite the slowdown relative to what Lowe's has done over the last 10 years. I see this as a very reasonable assessment of the overall situation for the business. Now, don't get me wrong, Lowe's is a stellar retailer, but the last few years have been unusually good for the business, and recent results are unlikely to persist indefinitely. The pandemic encouraged some people to move out of city apartments and into suburban homes, and some people were allowed to work from home. All well and good, but the pandemic is behind us. Furthermore, odds of a recession are rising, which would almost certainly reduce demand for home improvement projects. Putting it all together, Lowe's has to get back to a normal environment. Is a quote-unquote normal environment what CFRA has in mind? It does seem reasonable to me, and CFRA backs up their assessment with the following passage. And I quote, "Uncertainties remain in 2023 on how weak consumer spending may be with a potential recession. Home improvement spending is expected to see flat to negative revenue growth in 2023 as sales of existing and new homes slow, mortgage rates rise, and limited house price appreciation dampens home remodeling. Lowe's is improving store layouts, supply of products, and MVP membership with better service for pro contractors," unquote. On the other hand, I think we have to be careful about underestimating Lowe's. Lowe's roughly doubled its earnings per share in the 5 years leading up to the pandemic. That's good for a 19.1% compound annual growth rate in earnings per share during that 5-year stretch. Now, we can cherry pick good or bad stretches, but there's no doubt that Lowe's has operated at a high level for decades. That 60-year dividend growth track record doesn't get built by magic. I can take CFRA's projection at face value, with the payout ratio being low and with Lowe's predisposed to generously rewarding shareholders with large dividend raises. I don't see why Lowe's can't grow the dividend at least at a high single-digit annualized rate over the next few years, and you're starting off with an above-average yield. It's difficult to be unhappy about that kind of setup. Moving over to the balance sheet, Lowe's has a very good financial position. Because of negative common equity, there is no long-term debt-to-equity ratio. However, the $32.9 billion in long-term debt load is unconcerning for a company with a $118 billion market cap. Furthermore, the interest coverage ratio is north of 17. Profitability is quite robust for a retailer. Over the last 5 years, the firm has averaged annual net margin of 6.2%. Return on equity is not applicable because of negative common equity. Speaking on the margin expansion I touched on earlier, Lowe's was routinely printing net margin closer to the 4% mark a decade ago. Overall, Lowe's is easily one of the best retailers in all of America, and the company does benefit from durable competitive advantages, including large economies of scale, pricing power, brand recognition, product specialization, and an expert workforce that guides consumer purchases. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. I see competition as the biggest risk of those three, as retailing is notoriously competitive. Any major changes in the way consumers spend money can affect the business, such as possible pent-up demand for services as a result of lockdowns, leading to consumer spending flowing away from home projects. It's currently unknown how much of a pull forward of sales has occurred from pandemic-induced trends, but it's likely that near-term growth slowdown will materialize. Rising rates and high inflation will lower demand for new homes, although this may encourage people to stay in and maintain their existing homes for longer. A large-scale recession would almost certainly impact the business. The company's US-centric footprint eliminates international growth opportunities. The global supply chain is still not back to full strength, making it challenging to match supply with demand. I don't see these risks as too much to accept, especially when compared to the quality of the business. And with the stock down nearly 20% from its 52-week high, the attractive valuation only makes the risks easier to swallow. The stock is trading hands for a forward price earnings ratio of 14.4. That's based on the fiscal year 2023 EPS guidance at the midpoint. For a business that's compounded earnings per share at nearly 20% annually over the last decade, that's an extremely low earnings multiple. We can also compare the current price to cash flow ratio of 14.6 up against its own 5-year average of 15.9. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. Compared to the demonstrated 10-year growth across both earnings per share and the dividend, this is a very conservative model, but I'm erring on the side of caution, seeing as how the near-term EPS growth projection is near this level. My outlook for Lowe's over the long run is very favorable. However, it's also possible that we pulled forward a lot of long-term dividend growth, leading to more modest dividend raises over the coming years. For example, the most recent dividend raise was a whopping 31%. I think that gave investors a bit more bird in the hand at the expense of what's left in the bush. With EPS growth slowing, that kind of dividend growth just cannot continue. Still, a high single-digit dividend growth rate paired with a 2% plus starting yield is a compelling total package. The dividend discount model analysis gives me a fair value of $226.80. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates LOW as a 3-star stock with a fair value estimate of $218. CFRE rates LOW as a 3-star hold with a 12-month target price of $235. We're all pretty much on the same page here. Averaging the three numbers out gives us a final valuation of $226.60, which would indicate the stock is possibly 12% undervalued. Here's the bottom line, guys. Lowe's Companies Inc. is one of America's best retailers. It's really one of America's best businesses, period. With a market-beating yield, a double-digit long-term dividend growth rate, a low payout ratio, 60 consecutive years of dividend increases, and the potential that shares are 12% undervalued. Long-term dividend growth investors looking for a good deal on a high-quality Dividend Aristocrat should have their eyes on this name. And now for a special news announcement. Truist Financial Corp, stock ticker TFC, just got an upgrade to buy from Citigroup analyst Keith Horowitz, stating, and I quote, "Our view is that the deposit outlook is fine," unquote. This stock, along with pretty much every other bank stock, has been hammered after a few banks that weren't being managed properly went under. This could be the opportunity of a lifetime to buy into high-quality banks like Truist Financial, which now sports a price-earnings ratio of 7.3 and offers up a 6.5% yield. Our recent analysis and valuation video on the bank estimated its fair value at slightly under $53 per share. Truist Financial is looking very, very interesting here. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.